Good morning and welcome to the ARC protocol. And the digital world is buzzing with a single seismic shift in the code of corporate responsibility. While the markets are still finding their footing, Big Tech has just rolled out a protocol that could redefine digital parenting forever. Our lead story today, a move that's sending shockwaves through the sectors of privacy, ethics, and platform governance. In an unprecedented step, a major platform has announced that parents will now be actively notified if their teen's search activity flags terms related to suicide or self-harm. This is not just an update, it's an algorithmic intervention into the most private corners of a family's life. Let's break down the architecture of this protocol. The system is designed to act as a digital tripwire. When a minor's account, linked to a parent's, searches for specific crisis-level keywords, an alert is triggered. This notification, sent directly to the guardian, will also be bundled with mental health resources. On the surface, this is being positioned by the platform as a landmark victory for child safety. Proponents are calling it a necessary tool for an age where parents feel increasingly disconnected from their children's digital realities. They argue this isn't surveillance, it's a life-saving signal flare. For investors, it signals a proactive attempt to get ahead of the fierce regulatory hammer currently being forged by lawmakers globally, potentially stabilizing stock value by mitigating future legal risks. But flip the coin, and the story gets infinitely more complex. Privacy advocates are sounding the alarm, and for good reason. They argue this system could have a devastating chilling effect, discouraging teens from seeking help online for fear of automatic disclosure, especially in households where communication is already strained or non-existent. The core question they're asking is monumental. Does a platform's duty of care override a young person's fundamental right to privacy? This move blurs the line between protection and intrusion, and the debate is just getting started. This leads us to the wider market implications. While this initiative is currently contained, consider it a beta test for the entire tech industry. If this protocol proves successful, either in preventing harm or simply in appeasing regulators, expect to see similar Guardian AI features rolled out across social media, messaging apps, and gaming platforms. This isn't just a feature, it's a new product category, and it forces us to reevaluate how we assign value to tech companies. Is the new premium on user safety, even at the cost of user privacy? In a day dominated by this single tectonic story, the usual market chatter seems secondary. Every boardroom in Silicon Valley is watching this unfold, not just for the public reaction, but for the legal and ethical precedents it will set.
Our lead story this morning, the gentleman's agreement is fracturing. The AI giants, Anthropic, OpenAI, Google DeepMind, promise to govern themselves responsibly. Now, in a world without codified rules, that promise is being tested, and sources are signaling the guardrails are starting to buckle. Let's decrypt that primary signal. For months, the narrative has been one of proactive self-regulation. These architects of our digital future assured the public and policymakers they could manage their own creations. But a new analysis is highlighting a stark reality. In the absence of hard-coded legislation, there is little to protect these firms from the immense competitive pressure to deploy first and ask questions later. This isn't just about ethics, it's a systemic risk. When the creators of the world's most powerful algorithms admit their self-imposed checks are fragile, it sends a tremor through every industry reliant on their technology, from autonomous logistics to predictive finance. The question is no longer if regulation is coming, but what shape it will take and who will be caught on the wrong side of the code when it drops. Now for our secondary focus. A major protocol in the decentralized finance space is facing a critical stress test. According to a report from a cascade of liquidations triggered by market volatility is pushing the platform's stability mechanisms to their absolute limit. This is a live fire exercise for the entire DeFi ecosystem. If the protocol's automated defenses hold, it's a massive proof of concept. If they fail, the contagion could spread faster than a zero-day exploit. We're watching the liquidity pools and governance tokens closely. Pivoting to hardware, we're tracking renewed anxiety in the semiconductor sector. Reporting from indicates that new geopolitical tensions are threatening to disrupt key supply chains for advanced node manufacturing. Companies that failed to diversify their sourcing after the last crunch could see production schedules slip, impacting everything from EV manufacturing to data center construction. Time for the blitz round. Here's what else is hitting the wire. First, reports that venture capital is doubling down on next-generation battery technology with a focus on solid-state solutions for longer-lasting, safer energy storage. That's the data stream for this morning. The markets are booting up to a reality where digital promises require concrete enforcement and physical supply chains remain stubbornly fragile. The outlook is volatile with a chance of systemic shock. Keep your systems patched and your portfolios diversified.
Our primary feed is flagging a single unsourced data packet that came across the wire overnight. There's no source attribution from our usual feeds at CoinDesk or CNBC, just a stark, minimalist directive. The message contains a single command: drop true. We've run every diagnostic, and it's not a system error. This appears to be a deliberate, anonymous signal broadcast across the network. Analysts are scrambling to determine its origin and intent. Is it a warning, a market manipulation attempt, or a signal from a major whale preparing to liquidate a massive position? Whatever the source, a command this blunt cannot be ignored. It's put the entire market on high alert. Moving on, the lack of corroborating intelligence is, frankly, the second biggest story. Our terminals that are usually flooded with pre-market analysis from major outlets like TechCrunch are showing nothing but standard overnight performance. No major funding rounds, no product launches, no regulatory shakeups. This vacuum of news is creating a pocket of extreme uncertainty. The market abhors a void, and this quiet could be the prelude to a significant, high-velocity move when the opening bell rings. Our tertiary focus, therefore, becomes institutional positioning. We're cross-referencing this drop signal with wallet movements and futures open interest. According to on-chain data from Decrypt, there has been a noticeable, if not yet seismic, shift of assets into stablecoins over the past 3 hours. This suggests that at least some big players are taking the anonymous signal seriously and de-risking their portfolios ahead of the U.S. market open. There are no other major developments for a blitz round this morning. The board is clear, which only adds to the tension. So here's the outlook. Proceed with extreme caution. This drop true signal, combined with the news vacuum and the flight to stablecoins, points to a market coiled for a sharp move downwards. We expect heightened volatility at the open. Keep your leverage in check and your stop losses tight.
Morning and welcome to the ARC Protocol. We're cutting through the signal noise to bring you the data that matters. The lead story dominating the terminal this morning, a strategic power play in the marketing tech sector. 8 Company is making waves, announcing a series of key acquisitions aimed at cornering the market on video creation and advanced analytics. We're tracking the digital shockwaves, the acquisition matrix. Let's interface directly with the primary data stream. TechCrunch first broke the story, confirming 8 Company has acquired 2 smaller specialized firms. One, a dynamic video generation platform, the other, a next-gen data analytics outfit focused on predictive measurement. This isn't just about adding headcount, it's a calculated move towards vertical integration. By bringing these capabilities in-house, 8 Company is looking to build a closed-loop ecosystem, from content creation right through to performance analysis. They're betting that clients want a one-stop shop, a seamless solution that eliminates the friction between making compelling video content and proving its ROI. The question on everyone's mind, can they integrate these new assets fast enough to outpace the competition? Market algorithm reacts. Naturally, the markets are already processing the data. Our colleagues at investing.com are digging into the financial architecture of this deal. While the exact figures remain under wraps, the consensus is that 8 Company paid a significant premium. This is an aggressive, cash-heavy move that signals immense confidence in their future growth trajectory. Investors seem to be cautiously optimistic, with pre-market trading showing a slight uptick. But this high-stakes gamble also inflates their risk profile. Integrating disparate company cultures and tech stacks is notoriously difficult. We'll be watching their next quarterly earnings call for any signs of synergy or systemic friction. Good morning, and welcome to the ARC Protocol. I'm your lead anchor, and this is your essential market briefing. Our top story this morning cuts through the digital noise and strikes at the very heart of the financial system. A new report is forcing a difficult conversation about what Wall Street isn't telling you about your long-term investments.
and the implications are rattling the foundations of traditional portfolio strategy. Let's dive right in. Our primary focus is an investigative piece from Investing.com that peels back the curtain on long-term returns. The report argues that the figures presented in glossy pamphlets and quarterly statements are often a masterclass in misdirection. It highlights the vast and often undisclosed delta between nominal returns, the headline number everyone loves, and the real returns after accounting for decades of corrosive inflation and layered, opaque management fees. The data suggests that for many set-and-forget retirement funds, the actual purchasing power gained over 20 to 30 years is a fraction of what's advertised. This isn't just about market cycles, it's about the fundamental architecture of wealth management. Now, building on that theme, CNBC is analyzing the behavioral psychology at play. Their experts are pointing out that the entire reporting system is designed to pacify investors, focusing on short-term upticks while quietly masking the long-term erosion of value. They're examining how the complexity of financial instruments and the sheer volume of data are weaponized to discourage deep scrutiny. The takeaway is stark. The system thrives on informed apathy. It's a critical look at how investor complacency is not just a bug, but a feature of the legacy financial machine. And that brings us to our third story, where disruption is brewing. Decrypt reports a significant uptick in venture capital flowing into fintech platforms that promise radical transparency through blockchain. These protocols aim to put portfolio performance, fees, and inflation metrics on an immutable public ledger. The concept is simple. If the data can't be hidden, it can't be manipulated. While still nascent, this movement represents a direct technological challenge to the old guard's control over financial information, shifting the balance of power back toward the individual investor. Now for our Blitz round, a quick look at the other signals on our radar. First, that explosive report from Investing.com is forcing analysts to recalibrate long-term S&P 500 forecasts, factoring in higher sustained inflation. Second, the CNBC piece has triggered a debate on fiduciary duty, questioning if current disclosure standards are sufficient for the modern retail investor. And finally, Decrypt notes that established players like Fidelity are now quietly acquiring talent in the on-chain analytics space, a clear sign they see the writing on the wall. So what's the market outlook? Expect a wave of skepticism. This isn't just a headline, it's a paradigm shift. We're seeing a flight to assets that offer clarity and verifiable performance. Look for increased volatility in traditional asset management stocks and a surge of interest in decentralized finance platforms that prioritize proof over promises. The core message from the market this morning is clear. In the new economy, transparency isn't just a feature, it's the entire product.
In a market holding its breath, one story is making tidal waves across the globe this morning. Venture capital heavyweight General Catalyst is placing a multi-billion-dollar bet on India. We'll break down this seismic capital shift. All right, let's get straight to our lead story. Reports flooding the wire confirm that General Catalyst is sharply increasing its India investment pledge to a multi-billion-dollar mark. Now let's be clear, this isn't just another funding round. It's a strategic earthquake. We're talking about a firm with a legacy of backing titans like Stripe and Airbnb, now planting a massive flag in the Indian subcontinent. This move signals immense confidence in India's digital economy, its founder ecosystem, and its trajectory for hypergrowth, especially as other global markets show signs of cooling. This isn't just an investment, it's a statement that the future of tech innovation has a new center of gravity. So, why this move, and why now? This isn't happening in a vacuum. It represents a calculated pivot by smart money seeking explosive growth beyond the saturated markets of North America and Europe. With geopolitical tensions rerouting supply chains and data flows, India stands out as a democratic powerhouse with a massive, young, and digitally native population. This pledge from General Catalyst doesn't just fund startups, it sends a powerful signal to every other global VC. The message is simple: reevaluate your Asian strategy or prepare to be left behind. We could be witnessing the first shot in a new race for allocation in emerging tech. So what does this mean for the founders on the ground in Bangalore, Mumbai, and Delhi? In a word, access. Access to not just capital, but to a world-class network of expertise, mentorship, and go-to-market strategies. This injection of funds will undoubtedly target sectors ripe for disruption. Think AI, enterprise SaaS, and next-generation fintech. For Indian entrepreneurs, the game has fundamentally changed. The bar for ambition has just been raised, and the resources to clear it are now flowing in. Blitz round. Normally, this is where we jump to our Blitz round for a rapid-fire look at the markets. However, with the wire's attention so singularly focused on this monumental investment story, we're foregoing our usual segment to keep our analysis centered on the news that truly matters today. As we wrap up,
The message from the markets is crystal clear. Follow the capital. General Catalyst's multi-billion-dollar bet is a powerful leading indicator of where the next decade of growth is set to ignite. Expect market sentiment around Indian and emerging market tech to be overwhelmingly positive on the back of this news. That's your morning briefing. I'm your anchor, connecting you to the future. This is the ARC Protocol. Stay sharp.